Paying cash for a property versus putting 20% down. We're gonna dive into what is the better move if you have the financial resources, if you have the ability to do so. Is it good to have that property paid off? Is it good to own it outright, or is it better to have a larger portion of the property that you're actually making payments on? Well, we're gonna look at a few metrics, namely cash flow, equity, what the numbers can look like, and what the bottom line is with it all. And if you're new to the channel, my name is Tyler Roicki. I help people build income and wealth in real estate, and I run an international real estate team at eXp Realty. If you get any value whatsoever out of this video, all I'd ask is that you like, comment, and hit that subscribe button so that I can continue to share more tips and resources with you in the time ahead. And with that being said, let's dive right into the video. There's a big difference in utilizing leverage versus not, especially if your goal is to build a portfolio of property, to own real estate, to have equity working in your favor, and ultimately build cash flow. Now, the most obvious thing might be what the actual difference in cash flow looks like if you own a property outright versus not, because when you don't own it outright, you're paying the bank a substantial amount of money. It's important to know that there's gonna be less cash flow when you have to pay the loan, but it's not as bad as it feels like in the pocket, because the reality is there's a portion of that payment every single month that's going towards paying down your principal. And that amount going towards your principal will increase over the course of time on your typical 30-year amortized loan, because the way those loans are amortized is you're paying more of the interest up front and less of it on the back end. So as time progresses, there's gonna be more and more and more of your payment going towards the actual equity you're paying in the property. So again, it's not as bad as it feels in your pocket every single month when you're making that payment and having a minimal amount of actual cash flow, because there's a part of it going towards your equity at the same time. Also, it's important to note, mortgage interest is tax deductible. So it helps to actually reduce your tax bill when you have mortgage interest being paid versus not. Now, let's look at the next thing, equity. So that's the cash flow. Obviously, you'll have more cash flow if you own the property outright, but you don't have those other two elements at play when you own the property outright. So let's look at equity though. So imagine you have 5-to-1 leverage versus 1-to-1 leverage. That's the situation. If you have 20% down, it's 5-to-1 leverage, meaning you control 100% of the asset with 20% of the cash that it would take to buy that asset outright. So that's leverage, 5-to-1 leverage. Now, on the other hand, if you own the property outright, if you pay cash for it, you in effect have 1-to-1 leverage, meaning you don't have leverage, because every dollar you put in is controlling $1 of the asset versus every dollar you put in controlling $5 of the asset if you have 20% down. Now, principal pay down, I want to hit on that one more time. It's the portion of your housing payment that goes towards the principal. If you own the house outright, as funny as this might sound, you don't have any portion of the payment going towards the principal. You own all the principal at that point. So when the market goes up, the value of the house will go up in correspondence with the market. Rents can go up too. And that's one of the biggest benefits of owning real estate, is how you can actually gain and build the equity in the process. Now, think about this though. So all else equal, the value of the property goes up the same. Your ROI will be higher if you have leverage versus if you don't. Because imagine the property goes up in value 20% from the purchase price. If you put 100% of the cash on it, that's a 20% gain on your equity. On the other hand, if you put 20% down and the property goes up 20% in value, how much did your investment go up in value? Well, if it went up 20% and you put 20% in, it actually went up 100%. So your ROI is higher, all else being the same, when you have 20% down and can capture 100% of the upside versus when you put 100% down and can capture all the upside. Hope that makes sense if you're following what I'm saying. If not, you might want to rewind and play that back one more time. But same too if the rents go up over time. You're capturing more and more of that ROI than if you had put all the money down. Now let's look at the numbers, because this might help make it all make more sense. I'm gonna use an actual example, because I could tell you hypotheticals all day, but I'm gonna use a scenario of my rental house and what the actual numbers look like with it. So this is a house purchased a little over 2 years ago, in which I did put 20% down. So let's look at what the difference would be if I had paid cash. And so purchase price was $305,000. And let's say that that was a cash purchase. So there would be no principal and interest payment. Property taxes would be there, so would insurance, HOA dues, and any services related to the house. So my actual cost between taxes was about $6,254. Insurance was $1,979. HOA dues about $600, and a plumbing service contract I have, $156. That totals out to $8,989 in costs, which breaks down to $749 per month. Market rent is $2,550. And after my property management fee kicks in, because I have that taken care of, it's $2,346. So if I subtract $2,346 in income from $749 in costs, that will amount to cash flow of $1,597 per month if I had paid cash for the property. And that breaks down to $19,164 per year. And that doesn't count for if there are any additional expenses that pop up, which there might be, maintenance needs, you name it, it's part of owning property. But let's just use that number to look at this example. And also I want to add something in there, appreciation. So typically you purchase a property, you'd be conservative on appreciation. I will say, since we're talking real numbers here, the appreciation has been unusually high in this particular market for this particular house over the last 2 years. So reality is 2 years later, this house has appreciated and is now worth $410,000. That's $105,000 in equity gain. It's not your normal appreciation rate over 2 years, but nonetheless, if we're accounting for that actual number, ROI has been 23.5% when you account for the annual return on investment having owned this property, accounting for the cash flow, as well as accounting for the equity gains. Now, another key metric to look at is return on equity. You know, based on the equity that's actually in the house, what's that annual return looking like? It's 17.5%. The reason it's lower is because what you'll find over time is the more equity that you get built up in the property, the less the return on equity is going to be year by year by year. And so ROIs, the initial investment return on equity, accounts for the value of the property accumulating, in which at some point in time you could take it out. And that's actually why it makes sense over time to either take equity out or sell properties at some point, because at some point that number is going to get lower and lower and lower. It's going to make more sense if we can put the money to use in a place where it's going to generate a higher return. Now, let's look at the difference, how it differs from my actual 20% down scenario. Same numbers, just, you know, we're looking at a cash scenario. Let's look at the actual one, 20% down. So $305,000 purchase price, 20% down, $61,000. So $244,000 financed at 2.99%. So low interest rate, that was the time that this was purchased, that's where rates were at. So PITI, principal, interest, taxes, insurance, were total $1,733. HOA fee, $50 a month. Plumbing service fee, $13 a month. So total monthly costs, accounting for all that, $1,796 per month. Rent, $2,550. Or after property management fee, $2,346. So that's the income coming into me. That totals out, when you take away the expenses, $550 in cash flow per month, or $6,600 per year. Now, what's the difference though? And here's the key. What does the ROI and ROE look like based on having leverage versus if I didn't have leverage? Well, my return on investment, the initial cash invested, is about 97% year over year. 97% versus 23.5% in the example if it were an all cash purchase. Return on equity, which again, accounting for the fact that 2 years later the house has appreciated $105,000 and is now worth $410,000, return on equity is 33%, so still higher. That's 33% versus 17.5%. So as you can see, substantially larger return based on not having paid all cash, because the money is able to do more with the built-in leverage. Now, there's some benefits, and I want to point out like that you actually have with the mortgage that you otherwise wouldn't have. So principal pay down is one of them. Every month there's a portion of my payment going towards the principal. At this point in time, it's $446 per month. So of that housing expense, $446 is going directly back into the equity, and that increases over time due to how the loan is amortized. So it's always gonna go up. It's always gonna be more than $446 per month from this point onward until the loan is paid off. Now, you also get some tax deductions, namely one that you wouldn't otherwise have, which is interest, because you can still take other deductions that apply whether you own the property outright or not. But the interest one, if you own the property outright, you aren't paying interest, so you don't have that one. Well, since $6,972 per year is going towards my interest payment, that is money that can get reduced from my taxable income, which helps save taxes. Let's say the marginal tax rate is 22%. That could mean about $1,500 in tax savings. And again, it's best to get with the CPA to make sure this is all accounted for correctly. That's exactly what I do. But taking appreciation out of the picture, return on investment is still better, right? So the property has appreciated an unusually high amount. It's definitely higher than I would assume for market appreciation. But even if we take that out of the picture, you're talking about a 19.6 ROI versus a 6.3 ROI if we didn't factor any appreciation whatsoever. And that's factoring in cash flow and depreciation, not to mention the added tax benefits of mortgage interest that you get to deduce. You know, that's not factored in there. And the ROE decreases as equity rises. So again, big takeaway from this: over the course of time, as you pay more and more and more in, as far as paying down your mortgage, and even if the equity goes up too, the return on that actual equity you have building up in the property is going to be lower and lower and lower, because the property is only going to cash flow so much. And if the actual value of it goes up that you own, your returns are going to drop and drop and drop. And again, this is why it will make sense over time to trade up in properties, to take the equity out and go and do other things with it and put it to work in something that's going to generate a higher rate of return in. And that's just a natural part of the process. So bottom line with all this is, if you want to generate larger returns and gain more equity sooner, it makes more sense to use mortgages and loans than to pay cash for the property. There's probably a point in life that it makes sense to own your own home outright, and I think that's a great goal to strive for personally. But if we're looking at generating the most in the way of returns, building the most equity as well as cash flow too, even though on the onset it's lower, there's just more at work for you when you have leverage. So leverage allows you to own more real estate using the same amount of capital, and the more real estate you own, the more equity, cash flow, and tax benefits you can stand to gain in the process. And so my take is, if you're gonna invest in real estate and build a portfolio out, the goal should be to own and control as much real estate as quickly as possible. Don't over leverage by any means, but buy right in the right location, where the numbers work as far as the property being able to cash flow and sustain itself enough so that you can actually own it and be on top of the management and whatnot. But don't over leverage. But that being said, the goal should be to own and control as much real estate as possible, as soon as possible, when you can control for all those factors, and to minimize your risk in the process. And something that helps with that too is, even though you're not owning 100% of the property, have a solid amount down that you're paying. 20%, that's generally what lenders want to see, 20 to 25% for long-term rental properties. And that gives you a cushion of equity that you have in case anything changes with the properties. And it's also easier to cash flow when you actually have some equity and are funding 75, if not 80% of their value versus 100%. The numbers are gonna work better that way, and that's gonna help to keep you in a better position to ride out the ups and downs that happen throughout the process. And then also note, velocity of money is going to be at play the more you take these returns you're generating and put it back into doing more for you, because the sooner you can generate larger returns, the sooner you can put that money to work to generate more returns for you. So it's like a snowball effect. It's like a snowball rolling down a mountain. the more and more it rolls and builds up, the more, the bigger it becomes, and the same concepts at play as you're building your real estate portfolio and ultimately your vision for what you want to do in real estate. So I hope this video added some insight for you. If it did, if it added to your mindset in terms of how to navigate this realm of real estate, all I would ask is that you support the video and the channel. So drop a like, drop me a comment, and most importantly, make sure you hit that subscribe button so that I can continue to share more tips and resources with you in the time ahead. If there's anything I can possibly do to help you out beyond this video, go ahead and send me an email. You'll find that information along with some other helpful resources for you in the description below. And with that being said, thank you so much for watching the video. And until next time, I'll look forward to seeing you on the next video.